In this teaching tutorial, I explain you how to calculate capital asset pricing model. Capital asset pricing model, popularly known as CAPM and pronounced as CAPM model. Pronounced as CAPM model. So CAPM model is used to determine an appropriate required rate of return of an asset. And the equation we use to calculate CAPM is expected return is calculated using plus so here RF is risk-free rate and is beta or systematic risk of a stock or an asset. Then RM is return on market. RM is return on market. So what is that we are trying to do is we are trying to, and this portion, that is RM minus RF in equation, is what we call as a risk premium, and this is risk-free rate. So your expected return is risk-free rate plus beta times of risk premium. And in your equation, beta is calculated equals to covariance of x y by variance of x, and here x is market index and y is stock. Now how is it we are going to interpret a beta? So suppose we have a stock A and risk-free rate is normally given in a books, whereas in a practice risk-free rate will be, so a risk-free rate will be yield on 10-year government bonds or any amount that is on a government investments like a fixed government bonds or T-bills are considered as risk-free rate. So we have a stock A which has got a risk-free rate of 10% and its beta is 2, and during the period return on the market is 14%. So our expected return equals to risk-free rate is 10% plus beta times beta is 2 and return on market is 4 and risk-free rate is 10. So this equals to 10 plus 2 into 4. So 10 plus 8 equals to 18%. So your required rate of return is 18%. And now compare this with the stock which you are considering to invest and check if it is paying you more than 18%. If historical return of the stock is more than 18%, then invest. If it is less than 18%, then think twice. And how is it we are going to compare the stocks using a beta? So in all the cases, the risk-free rate for a particular point of a time will be the risk-free rate as well as return on market will be the same. So beta is what actually makes a difference. So suppose we have another set of stocks B, C. So risk-free rate remains same and beta of this stock is 1.5 and return on market again remains the same and risk-free rate is 10 here, 14 it will be same and beta is 2.5. And if you substitute the values in the equation, then this equals to 10 plus 1.5 into 14 minus 10. So this equals to 10 plus 1.5 into 4, so 16%. Then 10 plus 2.5 into 14 minus 10 is equals to 10 plus 2.5 into 4. 10 plus 10 is equals to 20%. So as the stock beta increases, your expected return is also increasing. So in case if you put this, when beta is 1.5, expected return on a stock is 16%. When beta is 2, expected return is 18%. When beta is 2.5, expected return is 20%. This means when the beta, the systematic risk, increases, beta is the systematic risk. When systematic risk or risk is high, investor expectations from the stock or investors required rate on a stock also increases. So we can say as the risk increases, expected return or required rate of return also increases.